Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 2. This is Section B. This is an application topic. Calculate capitalized software developed for internal use or software developed for sale to be reported in the financial statements and the related amortization expense. And we're going to be doing that the Superfast CPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you check out becoming a Superfast CPA Pro member. Now, just letting you know, in today's video, we are only going over 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So again, if you like this and you like our other videos, make sure you check out becoming a Pro member so you can get a full access to the 10-question videos. Now, with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out as we get into these questions is you want to read the last question or the last sentence of the question first, because frequently that will give you the context for what the question is actually about. So you want to read that last sentence first, and this will give you a lot of context, and this will be very helpful for test day because you have no idea what you're going to be seeing on the exam when you get to the exam. So you may as well have a strategy for figuring out what each question is about as quickly as possible. So whenever you can, do this, read the last sentence first. What amount should TechCore capitalize as software development costs? Okay, let's go to the top. TechCore Inc. is developing new software for internal use. During the project, the following costs were incurred. Planning and feasibility study, $35,000. Design and coding after the project moved into the application development stage, $90,000. Testing to ensure the software works as intended, $20,000. Training employees to use the new system, $15,000, and data conversion costs, $10,000. So out of all these different costs, what can they capitalize as software development costs? Now, if you have any idea how this works, that's great. You might be able to figure this out, so pause the video. But if you've never seen this before or you don't really understand it, that is okay. We are going to use these questions to learn the material. So let's dive into the explanation together to start learning. All right, here we are at the answer B, $110,000. That's how much they can amortize as software development costs. So let's go through this. For software developed for internal use, and that is important because there is a difference between internal use and for sale. Capitalization is based on the project stage, not on technological feasibility, and that will come in later. Costs are treated as follows. For preliminary project stage, which is like the planning and the feasibility studies, that's expensed. That is not capitalized. Now, the application development stage where they're designing, they're coding, they're testing, that is something that will be capitalized. That is the software development costs that will be amortized. And then the post-implementation stage, which is like the training, the data conversion, and again, remember this is for internal use, so it's not being sold, that is expensed. So in this case, the design and coding, $90,000, that will be capitalized. The testing will be $20,000, and that's capitalized as well, so the total capitalized amount is $110,000. The other costs, the $35,000 for planning, the $15,000 for training, the $10,000 for data conversion are all expensed. So again, just to point it out, when it comes to internal use, it's based on the project stage, mainly the application development stage. That's what's going to be capitalized. Now, I want to point out one thing. If this were software developed for sale, which we will be talking about, the rules would differ. Only costs incurred after technological feasibility is established and before the product is available for sale would be capitalized. And again, we're going to talk about more about that. So that is the first question. We're learning about what is going to be counted as a software development cost that is amortized when it is for internal use. Now let's go to the next question. All right, here we are at question 2. What amount should SkyLayer capitalize as software development costs? So same question, but it's probably going to be a different situation. Let's go up to the top. SkyLayer Inc. is developing new software that it plans to sell to customers. So just pointing that out. This is for sale, not for internal use. The following costs were incurred during the development process. Conceptual design and product planning, $50,000. Coding and testing completed before technological feasibility was established, $60,000. Coding and testing completed after technological feasibility was established, but before the product was available for general release, $80,000. Packaging and marketing costs, $30,000. So again, what amount are they going to be able to capitalize as software development costs when it's for sale? Now, this is a little bit different, and we talked a bit about it in question 1, so you might have an idea. Give this a try, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A, $80,000. So let's talk about this. It is different when it's developed for sale. For software developed for sale, US GAAP requires capitalization of costs only after technological feasibility is established and before the product is available for general release. So that kind of middle ground, that kind of in-between stage. These capitalized costs generally include coding, testing, and other development work in that window. Costs incurred before feasibility, such as planning, early coding, and testing, that's expensed. Costs incurred after feasibility, but before it's released to be sold, that's what's capitalized. And again, when you're selling this. And then costs incurred after release, the marketing, the packaging, after you start selling, that is also expensed. So again, it's just that one spot in the middle where it's after feasibility has been determined, but you haven't started selling yet. Those are going to be the costs that are capitalized. Now let's go through this. Capitalized costs in this situation. That would be the coding and testing after feasibility, but before release. That's $80,000. That's what's going to be capitalized. Now, what's going to be expensed? Everything else. The planning for $50,000, the early coding and testing for $60,000, which was before the feasibility was established, and the marketing/packaging, which is after feasibility and after they start selling, that's $30,000. This differs from internal use software, which uses project stages to determine capitalization. For sales software, the key is technological feasibility, which typically occurs when a detailed program design or working prototype is complete. So they've made a working prototype, stuff is working, but they haven't started selling it yet. All the stuff that happens in between then is going to be capitalized when you are talking about software development costs for something that's going to be sold. So now that we've talked about in the first two questions how to determine what is a software development cost that's going to be capitalized, now in the next questions we can start talking about calculating the amortization. So let's go ahead and take a look at the next question. All right, here we are at question 3. What amount of amortization expense should Catalyst recognize for the current year? Let's go up to the top. Catalyst Systems capitalized $600,000 of software development costs for a new product made available for sale on January 1st. The software is expected to have a 4-year useful life. At the end of the first year, actual and estimated revenues are as follows. Current year revenue, $300,000. Total estimated revenue over the product's life, which is the 4 years, is $1 million. So again, what amount of amortization expense should Catalyst recognize for the current year? So now we're starting to talk about how you calculate the amortization for software development costs for something that you're selling. So this is a little bit different. Now that we understand what happened in question 1 and 2, this is the next step. Now, if you know how to do this, that's great. If not, that's okay. We are going to look at the explanation to start learning. All right, here we are at the answer, D, $180,000. Let's go through how to determine that. For software developed for sale, and that's pretty much what we're going to be talking about the rest of this video, amortization must be based on the greater of either the straight line method or the percentage of revenue method. So those are the two methods that you're going to be comparing when it comes to amortization, and you're using the greater of either one of those. So if we did the straight line method, we would take the $600,000 of development costs divided by the 4 years that it's going to be being used, and that's $150,000 of amortization in year 1. Now, compare that to the percentage of revenue method where you take the year's revenue divided by the expected total revenue over the course of the whole life, and then you multiply that by the development costs themselves. So you take this percentage, which is 30%, as you can see, 300,000 divided by a million, 30% multiplied by 600,000, that gives you $180,000. And you can pretty easily tell that $180,000 is greater than $150,000. So the company must recognize $180,000 in amortization for the current year. So just to make sure that that's clear one last time, for software developed for sale, GAAP requires using the greater of the straight line or the percentage of revenue method for amortization, and you do that each year. Some years the straight line might be greater, some years the percentage of revenue might be greater. So again, you compare the two, and that is how you determine the amortization for software that's being sold. So we learned a little bit more there. Now let's go to the next question. All right, here we are at question 4. What amount should Alpine Tech report as software development expense in the current year? Let's go up to the top. Alpine Tech capitalized $500,000 of software development costs incurred last year, and that was after technological feasibility before general release, for a new software product made available for sale on January 1st. The software has a useful life of 5 years. The following costs were also incurred during the year. Planning and design before technological feasibility was established, $120,000. Packaging and marketing, $60,000. Revenue for the current year, $300,000. Estimated total revenue over the product's life, $1,500,000. So again, what amount should they report as software development expense in the current year? Now, take what we learned in the first 3 questions, think about this, try to figure out what the answer is, because I do want you to try it, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, $280,000. Let's walk through this. This is kind of combining some of the stuff that we've learned so far. So the GAAP treatment for software developed for sale, for the expensed stuff, you take the planning and the design before feasibility, and that was $120,000, and the marketing and packaging, which was after the release, and that's $60,000. And then there is the capitalized costs, which was the coding and testing after feasibility, but before they started selling it, and that was mentioned at the beginning of the question. In the previous year, they had the $500,000 of costs that were after feasibility, but before they started selling it in January 1st. And then the amortization is something that we do need to figure out because that is an expense. So we compare straight line, which would be the $500,000 that's going to be amortized, divided by 5 years, and that's $100,000, or the percentage of revenue, which is $300,000 divided by $1,500,000, which gives you 20%. Multiply that by $500,000, and that gives you $100,000. So either way, whether you use straight line or percentage of revenue, you are getting amortization expense of $100,000. So now we can add up all the expenses, costs that were already being expensed and the cost that is going to be amortized, the amortized expense in the year. So 120,000 plus 60,000 plus 100,000 gives you $280,000. So just to kind of make sure that that's clear, this question specifically asked for the software development expense in the current year. And so we took the items that were expensed because they were before feasibility or they were after they started selling. And then we took the capitalized amortization expense for the year and we added that because that is technically also a software development cost in the current year. So we were kind of combining some things there in this question. Now let's go to the next question. All right, here we are at question 5. What amount should Halo Wave recognize as amortization expense for year 1 related to the capitalized software? Okay, let's go up to the top. On January 1st, Halo Wave Inc. capitalized $600,000 of software development costs for a new product available for sale to customers. The product is expected to generate the following revenue over its 4-year life. For year 1, $600,000. For year 2, 3, and 4, each of them is going to have $300,000. In year 1, the company also incurred the following expenses: customer support, $80,000, marketing campaign for the software, $60,000, administrative overhead, $100,000. So again, what are they going to recognize as amortization expense for the first year for this capitalized software? Think about this. Take everything you've learned so far. I think you could do this. Come back when you're ready and we'll look at it together. All right, here we are at the answer, C, $240,000. So let's walk through this step by step. Now, to be able to figure all this out, we have to first figure out what the total expected revenue is, because we're going to need to use that to figure out the percentage of revenue amortization. So total expected revenue is the $600,000 plus $300,000 plus $300,000 plus $300,000, and that's $1,500,000. So that is the total expected revenue. Now we can figure out the straight line amortization and the percentage of revenue amortization. So in this case, for the straight line, we take the $600,000 of amortized costs, divide that by the 4 years that it's going to be there, and that's $150,000 of straight line amortization. Now we look at the percentage of revenue, and that is $600,000 for the first year. That's the revenue in the first year divided by the total expected revenue of $1,500,000, and that gives you 40%. So 40% multiplied by $600,000 gives you $240,000. So between the two, the percentage of revenue obviously gives you higher amortization. So you take that one as the greater of the two, and so that is going to be the amortization cost for year 1. Customer support, marketing, and overhead, these are completely unrelated to the amortization calculation. They're not unrelated to other things, but of course, when it comes to specifically calculating the amortization, we didn't need those. So again, the key takeaway here, always calculate both amortization methods and choose the greater, ignoring unrelated operating expenses. Remember, so don't just assume it's always going to be percentage of revenue. Don't just assume it's always going to be straight line. You need to compare the two to see which one is greater, because that is going to be the amount that you use for the amortization for that year in question. So we learned a lot in these first 5 questions about what is considered a capitalized software development expense and how to figure out the amortization expense for those software development costs that are amortized. Now, before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you how to calculate the amortization expense for capitalized software development costs, or whatever the case is. Again, you notice these things throughout the questions and you're doing them over and over again. So you take a moment and you write out the key things that you're learning, the pillar topics, based on what you learned and saw from the questions you were doing. And as you are doing this each day, you are building your own personal repository of the most important things you learned from the questions so that you are ready for the exam when you get there. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, capitalization rules differ for internal use and for sale software. Internal use software costs are capitalized during the application development stage, while for sale software costs are capitalized only after technological feasibility is established and before general release. Now let's go to the next one. Pre-feasibility, training, data conversion, and marketing costs are always expensed, regardless of the software's purpose. Planning, training, data conversion for internal use, and marketing or support costs for sale are not capitalized. So you're going to have some expenses that are not going to be capitalized either way. Amortization for software developed for sale begins when the product is available for general release. Once the software is ready for sale, amortization must begin using the greater of the straight line method or the percentage of revenue method, and we talked about that quite a bit. Now let's move to the next one. Total expense includes both amortization and any other development costs that are not capitalized. Pre-feasibility costs, post-release marketing, and amortization of capitalized amounts all contribute to the current year's total software development expense. And then finally, percentage of revenue amortization requires calculating total expected revenue. When using the percentage of revenue method, total expected revenue must be calculated from the full stream of projected future sales to determine the correct amortization amount. So you have to actually add up all of the projected revenues so that you can know the total revenue, so that you can compare that to the revenue that they have in the current year. And that's how you'll be able to have the percentage of revenue for amortization purposes. Now, with all that, we learned a lot in the first 5 questions and in the pillar topics. And as a reminder, in this YouTube version of the video, we are only going over that. We are not going to go over the next 5 questions, which I will be going over with the SuperfastCPA Pro members, and I'll finish that video after I finish this. So make sure you check out becoming a SuperfastCPA Pro member if you want access to the full 10 question versions of these videos so that you can get a little bit more help and a little bit more understanding. Now, the easiest way to learn about and become a SuperfastCPA Pro member is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months failing exams. And after you watch that, you will have a better path to learning about and becoming a SuperfastCPA Pro member. So check out the webinar, check out becoming a pro member. If you found this video helpful, make sure to like it and leave a comment. I hope it was helpful, and I will see you in the next video.